whether you like it, whether you don't like it, it's not really the question, but you can see it does work. And little buy trade at the bottom edge here for this morning's London session. It's the only trade we had in London. Sell trade here, interesting. It still made money. Buy trade here, very nice. Sell trade here, pretty good. And buy trade here, made some money. Sell trade here, made some money. And obviously that model now switching off for the afternoon session. At this point, switching off for the afternoon session. And what we're looking at is just value. Anytime we build any models, it's about trying to look at the relative value of something against something else and see if it has a relationship that is tradable. And the way you build those types of models is you ask very simple questions. What do institutions trade in terms of, for example, hedge models? So if I want to hedge out some exposure, where does an institution go for that hedge? For example, you're trading dollar yen and you're trading yields, or you're trading the yield curve. So if you're trying to figure out a model, dollar yen against yields is a very good narrative to play into. Gold and silver is a rotational marketplace and you can hedge out those exposures. Well, if you know that the hedgers are coming in, one of the things you don't know is which side of the hedge, if you're going to be directional, which side of the hedge is going to work. And that's the one thing you've always got to remember, is that just because you have value in your market, if your intention is not to spread it, then you might be on the wrong side of the hedge, right? So if your intention is to spread this, maybe this isn't the sell, maybe whatever you're spreading it against is a buy trade here. You get what I mean? Get what I mean? So, this may then continue higher. If this is not a buy trade and the hedge is obviously available. Now, obviously, there's things that we can do to help minimize that. We can add an extra narrative to it. We can add an extra storyline to it. The time of the day could be, in this model itself, the time of the day is very important to me. Now, why is the time of the day very important to me? Because what I'm looking at here is I'm looking at the relative value of the S&P versus the indexes in Europe, right? Does that make sense between 8 o'clock and 1 o'clock? So obviously between 8 o'clock and 1 o'clock, the S&P and the NASDAQ are not the driving marketplaces, right? They don't drive anything, in fact, between those hours, the S&P and the NASDAQ. Because there's no stocks trading. No stocks trading at all. So why would they drive the marketplace? They wouldn't, right? So, you're getting the European stock markets, London stock markets, driving the marketplace. And if they're driving the marketplace, then there may be opportunities for something like the S&P to lag those opportunities. And that drives me into the hedge trade. Because what happens in those worlds, of course, is that you start finding people buying the DAX and selling the S&P, or selling the S&P and buying the FTSE, or buying the FTSE and selling the DAX. There's a lot of triangulations on these markets, trying to find the best equity value narrative. Well, that value narrative is then established as a model on my screens. And because of the time of the day, my feeling is that this model should lag the price, or the price should lag the model effectively. Because if you know what I mean, this is not the driving market for that time of the day. So therefore, I get this opportunity to maybe buy a bit of discount or a bit of premium. And obviously the discount's visible. There it is there. So we're buying that discount and we're selling what looks like a weird premium, but we're selling it anyway. We're buying the discount here. We're selling the premium here. We're buying the discount here. We're selling the premium here. So it seems to be, on the face of it, to be a very, very exciting model. Now, interestingly enough, if we actually join the dots, what you then see is you see this type of hedge matrix almost showing up, because it seems to go from a buy to a sell all the time instead of a buy to a buy to a buy to a buy kind of idea. So at the moment, you can see that buy into a sell, into a buy, into a sell, into a buy, into a sell seems to be hedging out, cross-border exposures. And when we understand that's hedging out cross-border exposure, we understand a little bit more about the business model that's actually taking place on the desks of many banks across Europe. So we can kind of understand this one as far as a model is concerned, can't we? But obviously, if you just traded those signals, obviously, interesting enough, if you just traded those signals, with the exception, obviously, of the fact that we get this very big pin rejection down here, which obviously would have required you to have a reasonable size stop and play. But obviously that trade there went from a price average of about 18s up to a high price of 28s. That's a $500 winner right there. That's pretty good for a basic model in half an hour. I mean, that's a pretty solid outcome, isn't it? So again, we can see that the relative value of knowing things like this is can be quite powerful, and it's about trying to represent that narrative in terms of a way that we don't end up misinterpreting what we're seeing and then having a timing where it stops. Now, it'd be interesting to see if this model stays in play in the US session, because obviously in the US session, the Nasdaq and the S&P lead the market across the world. So my feeling is that this is going to almost flip at times. It still shows relative value, but obviously that relative value may move from being in the US markets to the European markets. So I'll watch this model with interest. And, obviously that's why there's a black line here, because that's when the model basically is switching off, right? That makes sense? So the black line here is where I would switch that model off and I would stop using it. And, that's why I drew the black line on the charts there, so that we could remind you to highlight the idea that this model becomes possibly redundant from this point onwards. And if it's possibly redundant from this point onwards, we don't make silly mistakes just because, we're in pretty good shape. Anyway, we're talking about the COT today. We'll obviously touch on that as we go into classroom this afternoon. I was watching oil for a sell there. I took a sell off the 90 on oil for a first try at this short supply side. I did take a sell off of 90. I got down to a low price of 80. Woo-woo. I did put it in Ninja Trader, but we have actually been taken out at +1 plus a 10-tick winner. So there's the trade there. So you know that we were actually involved in that as a play, and we'll discuss why we sold it there. But you can see obviously it dropped for 10 ticks anyway, and it did get a stop at break even, no problem. So I mean, it wasn't a difficult trade by any means. And yet again, it's this idea of oopsies, I've taken the wrong thing away. It's this again, of course, this idea that simple box trades, simple boxes, simple range moves. Because obviously we've got a heavy supply area here, and that heavy supply area is, of course, based on the last rotation. So with that heavy supply coming in, at that point, I was seeing a little bit of value divergence on the crack spread. I was seeing a bit of value divergence on the yields. And, when we're looking at the supply line, there was a little bit of supply side divergence as well, wasn't it? So we had quite a lot going for us, except the crack spread was starting to pick up a pace on the bid side. So you can see that the refiners seem to be quite keen to buy some oil here. Do you see that? The refiners seem to be keen on buying oil. So, okay, so if that's the case, we kind of have a feeling that we might not be in this trade for very long. And as it transpires, we were only on the trade for 10 ticks and a scratch. So that's unfortunate what happens here. We were on the trade for 10 ticks. But do you see, by adding that extra ability to just get that bit of range, that all of a sudden you're relatively safe in where you're fading into these as moves. So you can see at the bottom edge here, for example, you can see if we take the supply line off, because that was having to return, but you can see into the bottom edges here. Sorry, get rid of this now. Into the bottom edge here, you can see that we've got a pretty reasonable divergence into the bottom edge here in the world of the bond traders, and then we start seeing the refiners buying oil into this 72.35 level. And obviously buying into that 72.35 level seemed to be a pretty good proposition, didn't it? Because, well, it's paid out. You can see it's actually paid out with what turned into be a reasonable swing. And we've obviously got a couple of prices, but the overhead prices are quite a distance away, aren't they? I mean, look at where we've got the unwinds. 73, 72.50 bidding 72, right? So between 72.50 and 72, you'd imagine we should find buyers, yes or no? So do you see that? Between 72.50 and 72, we should start finding buyers. So if I know that there should be some buyers in here, is there anything that stands out in that area that seems to represent a buyer? Well, this demand box might be a buyer. That big volume coming in now below these prices might be a buyer. So we start seeing a lot of evidence of potential buyers at 35. Gives me a great chance to just join in with a buy at 35, and that's exactly what we did. Joining in with a buy at 35, and as I said, we're not looking to start seeing that overhead until we hit something in excess of potentially 74 today. So we do have a fairly reasonable upside range, but obviously it's all about whether we have any value to stick around for that size of move, which now would suggest a potential $1,500 move to the upside. We've already gone $500, $600, $700 of it. Anyway, it's looking interesting. I haven't seen an awful lot of narrative building comments in the boxes again today. I know it's difficult format for narrative building because you've got to type the damn thing out. But I hope that at least you're doing it. I hope that at least you're having a thought, a process that develops out with those as ideas. Because obviously it's very, very important for us to make sure we always do go through that process, because that's where you learn stuff, guys. It's important. Anyhow, let's get through today's numbers. We do have very, very important data coming out in just 5 minutes, guys, so I want to get through this relatively quickly. So in 4 minutes' time, we do have US PCE numbers. So if you're in a position, make sure you book some monies, guys. Please make sure you book some monies. This is obviously a heavy hitter indicator. It is a very, very strong indicator of what the Fed looks at in terms of inflation. And it's coming out in just 3 minutes, 50 seconds. So core PCE numbers, very, very important numbers. Expected to show a slight rise from 0.1 to 0.2. And the headline numbers coming in here on a month-on-month basis, a rise from 0.1 to 0.3. Price index rising from 2.4 to 2.6. And this is for December, so they can't blame Trump on this one as well. This is for December if it starts going back up. And we wouldn't be surprised if it goes back up. Why? Because we still see the direct dealers strongly on the inflation expectations of higher levels, aren't we? They certainly haven't adjusted to the lower oil price. So we know that if they haven't adjusted to the lower oil price, then they're still expecting some inflation pressures. We know that. We've had a conversation about it for a long time. And so this number comes out in just 3 minutes. Other than that, we've obviously had a few numbers out in the morning session and the afternoon session. Nothing really of major significance. But obviously what we do see is, we see, for example, the German CPI numbers coming out in installments. And they were very soft this morning, actually. The Eurozone German CPI numbers forecast at 0.1 down from a 0.5. Actually came in at minus 0.2. Yes, they did. Minus 0.2 for the German inflation numbers. Now, obviously, that's a really, really good number, if you like, but it's so bad, it might be bad, because it really doesn't show a lot of growth in that German economy, does it? If they're getting minus 0.2% inflation coming in. And now, obviously, it's a welcome relief if you've got a lot of inflation. It is always a welcome relief. And, so if you get lower inflation, then, of course, that helps the market understand that it's not all doom and gloom. But that's all dependent if you're needing to see lower inflation to be bullish, because most of the time lower inflation means recession. And that's something you've got to always balance when you see these lower inflation numbers. If it's coming off a very high print, very welcome. If it's coming off a low print, not very welcome. Yeah. Not very welcome. Anyway, numbers are out, guys, in 1 minute, 40 seconds. So I'll leave the screen up and then we'll get started for the day.